We touched on this earlier with Carl Shamotta. There's a school of thought that the next interest rate move by the Bank of Canada will be an increase in rates. Our guest thinks this is likely to come in the fourth quarter of 2026, so it's a good way away. Let's get more from David Doyle, Head of Economics at Macquarie Group. David, great to see you. So your analysis here is that the Bank of Canada is done cutting rates and maybe 10 months or something from now, we'll get an increase.
Yeah, I mean, I think that's right. It's look, I think that there's a lot of factors that are supporting activity for Canada in 2026. In our view, of course, there's still a lot of uncertainty in terms of how things will play out. But we think there's a fair amount of cause for optimism. The uncertainty that has been plaguing Canada's economy, there's a lot of data that suggests that peaked in around the second quarter, around the time of Liberation Day in the United States. And as we look ahead, we think that, you're probably going to get progress towards a new USMCA agreement or CUSMA, as we call it here in Canada, at mid-year. And, that should further reduce uncertainty. Now, here in Canada, we might not love what that deal looks like. But even the fact that there's progress towards the deal and the range of possible outcomes narrows somewhat should support activity. And then you have some measures in the federal government's budget, such as immediate expensing of various forms of business investment that we think should be approved to be a positive catalyst. And now, as we saw on Friday, there's growing evidence that the labor market may be improving. Look, I think it's still early and the LFS can be a volatile survey, so we don't want to put too much weight on it. But I think that there's some evidence there that things are improving. And then on top of that, at least that things aren't getting worse. And when you look at the shifts in immigration policy that are taking place, if you have an improving labor market, it won't take long for the unemployment rate to start to fall and fall pretty rapidly. And we could have seen, the first signal of that on Friday with the sharp reduction in the unemployment rate. So when we look ahead, yeah, we think the odds are skewed towards the next move being a hike rather than a cut.
That sounds like it would be tough, though, for Canadian businesses. If we're not cutting and America is, to tend to push up our currency, and then the labor market gets tight. So companies won't be loving it.
So, I mean, look, if the labor market gets tight, I would say that that's a good thing, and particularly for the Canadian people. For Canadian businesses, they might look at that and say, oh, well, now it's more expensive, it might start to get more expensive to hire people. But that's often another catalyst for business investment, right? And I think that that's an area that we should be, as a country, looking to, do sorts of things like we saw in the federal budget, the immediate expensing, to ramp up that business investment. We've been well behind the United States on that for 10 to 15 years. And I think that's a big reason why our productivity growth has lagged. And it's a big reason why our real GDP per capita growth has lagged theirs. So to me, that would be a very good thing. A rate hike in the context of a strong economy, I think would be fine, right? I think that if the economy is proving to be strong, then a rate hike, you'll be able to sustain growth despite the fact the BoC would be moving. So I don't think it should be proved to be problematic. I actually think it would prove to be a good thing when we see it in 12 months, according to our baseline forecast.
Do you think the vast numbers of temporary workers that Canada brought in under the former Prime Minister, was that just an easy out for Canadian businesses? They were able to just get away with lack of investment because they had all that cheap labor?
Yeah, I mean, I think that there was a cost to that. And the cost of that was, when you're looking at your mix of capital versus labor input, when you get a sudden impulse of labor, there is a tendency for businesses to lean more on that labor input. And I think we saw that. And I think as you look ahead, that policy is now reversing. And I think that'll be a good thing for Canada, a good thing for Canadian businesses, a good thing for the willingness or the ability to invest, right? And so what we need in this country is to improve productivity growth, improve GDP per capita growth to increase the standard of living here. And I think I'm more optimistic on that than I've been in over a decade based on what I'm seeing. So I think that there is cause for optimism for Canada in 2026. And all of these policies I'm talking about, what we're seeing in the economy, the potential for a CUSMA deal, that's all part of the story from where we sit at Macquarie.
And David, leave us with a final thought. What about, I know you're a keen observer of the currency. Do you see a significant rally in the Canadian dollar over the next year if, as I say, the Fed cuts and Bank of Canada doesn't?
Yeah, so we think that the Fed just has one cut left, which we suspect will happen this week. And beyond that, we think that both the Fed and the Bank of Canada will likely be hiking by the fourth quarter of 26. So we don't, the policy rate differential, we don't really see as being a big driver in terms of our views. But, despite that conclusion, we're still, I think, quite optimistic on the Canadian dollar. We see it going, towards, in USD CAD terms, towards 131 or 132 over the next 12 months or so, which would be a sharp gain. And a big part of that, again, is just the economic environment that we're seeing, right? We think you have solid U.S. growth. Canada should follow suit. We think there's a lot of, I would think, negativity priced into the Canadian dollar based on the trade policy uncertainty. But if we're right and we get closer to a deal on CUSMA mid-year, that sort of weight or drag on the Canadian dollar should come out, and you should get, we feel a significant rally. So certainly we think more upside to the Canadian dollar than downside from here. And I think it's very possible that 2026 is a very good year for the Canadian dollar.
Wow, because 131 would be about 76 cents US for the Canadian dollar, and that's quite the rally.
Yeah, which is, by the way, it's still below purchasing power parity, which is I think around 80 cents. So, you could argue that there might even be more upside. We're not calling for that. We think our call is pretty aggressive as it stands. But yeah, I do believe that, that there are, there's this confluence of events that could take place in 2026 that could be positive for the Canadian dollar. And of course, that's only one side of the pair. The other side of the pair is that we see broad-based weakness in the U.S. dollar. So in that broad-based weakness in the U.S. dollar, we think, lends itself towards a stronger Canadian dollar.
Thank you very much indeed, David. Always great to hear from you.
Anytime. Thanks for having me.
David Doyle, Head of Economics at Macquarie Group.